Dividend stocks have been a go-to defensive play for decades, but over the last few years, rising interest rates and shifting markets, are dividend stocks really a safe bet or a trap for unsuspecting investors chasing yield?
So yeah, I think it's always a good topic to kind of throw out there because it's one of those age-old debates, right? We talked about 60-40 portfolio a couple weeks ago, and now it's the dividend versus growth stocks, or the value versus growth stocks. So in the last couple years, with rising interest rates, I think that's kind of put dividend stocks a little bit out of favor. But as we sit here at, basically all-time market highs, can those dividend stocks help, sustain a portfolio for, if in case there's any market downturns out there? Reason number two to really get into dividend investing is something we talk about a lot here, is an income stream. So, it's just, we talk about it all the time with planning. How do all the puzzle pieces fit together? I think one of the most important things you can take a look at from these dividend stocks is the income stream that it can create. So, if you're getting a nice steady, 3% or so income stream from those stocks, it helps take a lot of pressure off of the price fluctuation. When you don't have to sell stocks to fund your retirement, you're just pulling off the yield or the income.
Yeah, but here's the problem, man. The S&P 500 as a whole has a dividend yield of 1.25%. Mm-hmm. The MAGs, right? Google, Amazon, Nvidia, I guess you can maybe throw Tesla in there. They don't pay dividends.
Right.
They're growth stocks. Most stocks that pay dividends are kind of grouped into that value play. And yeah, I would say over the last few years, dividend paying stocks have been not sexy. No, like they're defensive stocks. They're there to generate income, and they're usually a sign of a great company. Mm-hmm. Great cash flow. They got, they don't have any debt, or they're paying it off. They're giving back to the investor. Adding value of owning a share into that company. Mm-hmm. But when you have a dividend yield on average of 1.25%, and maybe even like the Dividend Aristocrats, so if you're unaware of what that is, it's a collection of stocks that pay dividends over the last 25 years and have had a history of increasing those dividends through those years. That is a staple of a very solid company. They're established. Mm-hmm. And guess what? They're probably through their growth phase. Now they are in their grinding forward, paying out dividends, yep. Small movements. They're not sexy. They're not Nvidia's where they double in price every year, right? Those days are in the past. And when you can also compete, so like the Dividend Aristocrats, I would say pay about, I don't know, maybe 2% plus mm-hmm. or minus, 0.25% or something like that. Why, if you're chasing yield, why don't most clients and people that I've talked to are looking at CDs? They're paying 3 to 4%, zero risk, unless the bank goes out of business. You got Treasuries yielding close to 4%. That you can get on a short-term basis, maybe 1 month, 3 months, 6 months, 1 year, right? Those are in that 3 to 4% range. Some money markets are paying almost 3.5 to 4%.
Yep.
So this is not good for dividend-paying stocks, because if you're looking for income, it's not doing the trick anymore. And you can try and find what I would call the yield trap. Right? Why yield is not safe income? Some of the red flags are hey, if they're, a company might be showing a high dividend yield, but that's because maybe the price decreased, yep. Right? They're still paying the dividend based on a particular price, and the stock just went down.
Yep.
That's not a good sign, because odds are they might be cutting that dividend because they're not doing well, on a historical basis, and their next step is to maybe cut the rate, right? Cut the dividend, and once they do that, the stock's going to go down even more.
Yep.
So, are you really worried about yield, or are you worried about growth? It's very hard to have both.
Right.
So that's the big thing, and some of the other traps are, telecom. Like telecom companies typically don't grow anymore. They're they're collecting their subscription and they're steady eddies, and they have a high yield, but because they are cash flow positive, but they just don't grow that much. I mean, everyone's got a cell phone at this point.
Right.
Now you're just kind of picking up the scraps, like, hey, I don't like Verizon, I'm going to AT&T now. So we have those types of things going on. Same thing with REITs, right? I'm actually more concerned. I mean, you could get into bonds. And this might, I think we've had a show about bonds. Like this could be the time to investigate and get into bonds, because if the Fed does start, cutting rates, you would think that your bond asset will appreciate too.
Yep.
So again, what are we chasing? Are we chasing yield or growth? It's again very difficult to do both.
Yeah, I think you nailed it there with the red flags. That's something I definitely wanted to talk about, because that's I'd say that's one of the most common and key mistakes that I've seen over the years, are kind of the do-it-yourself investors who are chasing down dividend yield, and it seems that basically no other information matters to them at all. It's only what's the highest yield I can possibly find out there. And like Tony said, those companies are typically not doing very well. So, we don't want to throw everything else out the window just to track down stocks that are paying a high dividend yield.
Right. I know another, the best sectors for dividend growth, and right now is healthcare.
Right.
But and they're kind of a laggard because, again, not sexy enough. Right. Not sexy enough. Amazon, Google, Nvidia, AI, just give me more of it, right? We're AI to death at this point. I just had that conversation with our engineer. I believe in mean reversion. I don't feel that. It's just like the dot-com bubble, right? And it was so fun to, hey, I bought this stock. You ever hear of it? No. Perfect. That means it's going to go skyrocket, right? Did they make any money? No, it's even better. Right? They just created their website yesterday. Great. Things are looking up, right? Like that, I feel like we're in that type of fad, but fortunately, though the companies that people are chasing today actually make money. They are big. They are gigantic. They don't have debt. We use them in everyday life. And I'm talking about the mags, the Amazons, Googles, Microsofts of the world, things like that. Apple. That's at least the silver lining, where it's going to be hard to say we're going to have a crash because we're chasing ghosts. We're not. Like, they're actually awesome companies, the best in the world. But there's other awesome companies in the world that we use, healthcare companies, right? Pharmaceuticals. We all, there's a lot of aging demographic. That's kind of, both of those hit the aging demographic, and they have been laggards, except for maybe like someone like Eli Lilly, with their Ozempic, GLP-1 drugs that have really taken off. Energy and utilities, they pay great dividends, but man, they just don't grow. So I said it before, I'll say it again. It's like, what are you chasing, right?
Yep. So we kind of laid out there the pros and the cons of the funds. What do we think of kind of the like a dividend ETF versus collecting individual dividend stocks?
A lot of research goes into buying individual stocks. I can tell you that because I see how diligent our investment team works on a day-to-day basis, trying to identify the stocks that we want to buy, we want to sell, we want to watch. The ETF, broadens your exposure. If it holds 100 stocks inside that ETF and one blows up, are you really going to feel it? Probably not. Yeah. Right. So that's that's like buying a bond, right? I'd rather have exposure to thousands of bonds than 10 individual bonds.
Yep.
To get my yield. So, but you're going to get grouped in. Like I said, the S&P 500 is spitting out a 1.25% dividend because not every, I don't know what the statistic is. Like 60% of stocks don't pay dividends in the S&P 500. It's like 40%, something like that. So again, it depends, I guess, maybe on your risk scale and your how good are you at picking stocks.
Right.
If you're not good at it, then I would punt on that, on picking individual stocks, because honestly, if you're chasing yield and you see one that's high, it could be alarming. It could be worrisome. Right. So, so that's my take. How do you feel about that, Derek?
Yeah, we talked about it several times, especially with the technology and the AI stocks. No one out there is an expert at all those things. So using managers and using kind of lower cost ETF funds, they're just going to give you a much more broad and diversified basket of stocks. We talk all the time, by the time it hits your phone or your TV, it's all the news that you just read is already priced in. So there's with how information travels these days, it's very hard to get an inside edge that way. Just knowing stuff that the market does not know. So having an expert kind of help you out and pick those broad basket of stocks can be both safer and easier for the investor.
Yeah, it's just like our growth and income strategy, our individual stock strategy, our investment team runs. Every stock pays a dividend. We hold anywhere between 35 to 50 stocks at any given point. But it's a diversified basket. We're not holding 10 stocks and saying, man, I hope 8 out of 10 I hope 8 out of 10 work out for you. No, it's diversified. We're holding the pharmaceuticals. We are holding the banks. We are holding AI stocks, telecommunications. We're holding the big boys too, but we're missing some of them. We don't own, like that strategy doesn't own Amazon and Google and Nvidia because they don't pay dividends. So we're sticking to our guns, and that portfolio is actually doing very well. And it doesn't mean that we can't add them to the portfolio. If a client really wants them added, we can add them.
Yep.
But honestly, I was having a conversation the other day yesterday with a client saying, "Hey, is Nvidia still a good buy? Like, do you believe it's going to 500 in a few years?" I mean, it could, right? But it also went up 100% in the last 2 to 3 months.
Right.
So I don't know. Is right now the perfect time to buy it? I don't know. Right. I would probably say no, but I could be wrong. Right. I leave that to my investment team. Right. And I just feel like Nvidia would be a stock you'd want to hold forever, like Apple.
Yep.
Right.
Absolutely. I was just about to say that, and you guys are probably sick of us talking about it, but time in the market is better than timing the market. It's these day-to-day fluctuations. They're very hard to predict. It's much better to figure out what your overall strategy looks like and stick to that strategy. So we're not hopping in and out of different types of stocks all the time.
Right. I mean, Again, like the story on Nvidia is like, if you believe it's going to $500, do you care what you buy it at? I know entry point is an important thing, but if you're looking for the next dip and it doesn't come, what are you doing?
Yep.
You're not involved. So if your goal is that in a few years it's going to be 500, whether you buy it at 180 or 150, obviously you'd like it at 150, but if you missed it and you got in at 180, I don't know, but it's going to 500.
Right.
So it's almost like, by being greedy, you could miss out. Right?
Yep, for sure.
But, to kind of wrap this up, final thoughts is I do believe dividend investing will have its time again.
Yep.
Because when the Fed starts cutting rates and, I guess high yield, safe, quote unquote, safe bets like money markets, CDs, things like that, they will be coming down as the Fed cuts rates too, right? AI, again, we have these mags that are dominating or have dominated, maybe not this year in 2025, but in 23 and 24, have dominated the they have dominated the index performance, right? 10 stocks have, left 490 stocks behind. So a mean reversion.
Right.
All you need is something, what was that thing called? Like DeepSeek, right? If like a year ago, like came out and said, hey, we can produce AI like at 1/10 of the price.
Right.
And everything got rocked. It rattled everybody's cage. Well, it was not true. But what happens when the story comes out and it is true? It could.
Yeah,
You
absolutely.
don't know. So again, diversification is important, and that's the big takeaway. Diversified portfolios is, you might not hit a home run when 10 stocks dominate the index, but when they don't, you will outperform the index because those 10 brought it down, right?
Yep.
Like that, something needs to happen. Either the 490 stocks need to catch up, or 10 need to come back down to earth. So diversification.
Yep.
That's the name of the game.
Absolutely. All right, well, good stuff this week. If you guys have questions on dividend investing or anything else, maybe some topics for a future show, hit us up at info@swpconnect.com, and we'll talk to you next week.
The opinions expressed in the podcast are for general informational purposes only and are not intended to provide specific advice or recommendations for any investment, legal, financial, or tax strategy. It is only intended to provide education about the financial industry. Please consult a qualified professional about your individual needs.